They keep telling you cash is for criminals and tax cheats. I want to tell you what it's actually for. It's the only financial tool on Earth that doesn't report back to anyone. And that single fact is exactly why the people building our next financial system want it gone. The argument for eliminating cash doesn't start with some dystopian future proposal. It's already being built, right now, in legislation that's already passed, in pilot programs that are already running, in a surveillance architecture that's already been tested on hundreds of millions of people. Start with Europe. The EU has approved a uniform $10,000 cash payment limit applicable across all 27 member states, taking effect in July 2027. The official justification? Money laundering, crime, tax evasion, the same three words they always use. And look, nobody's defending money laundering here, but notice what the rule actually does. More payment flows move to traceable digital channels, increasing transparency around asset acquisitions, wealth transfers, and high-value purchases. Every transaction above that threshold now has a name attached to it, a record, a file. That's not a side effect of fighting crime. That is the mechanism. And the EU isn't alone. France already has a $1,000 cash limit, 1,000 euros. You can't buy a used motorcycle in cash in France without triggering a compliance flag. The floor keeps moving, and it only ever moves in one direction. While Europe is capping cash transactions, over 130 countries are simultaneously in some stage of developing central bank digital currencies, CBDCs. This isn't a fringe experiment. This is coordinated global infrastructure being built in parallel with the slow strangulation of cash. The live test case is China, and it's worth understanding what China's eCNY actually is, because it is not just a digital version of the yuan. China's digital yuan added programmable payments in 2025, allowing millions of businesses to automate conditional payments and smart contract functions across 31 provinces. Conditional payments. That phrase is doing a lot of work. What it means in plain English is this: the money itself can be coded with rules. It can be restricted to approved vendors. It can be set to expire if you don't spend it by a certain date. It can be frozen the moment an authority decides you've stepped out of line. No court order, no appeal process, no delay. The money just stops working. That's programmable money, and it is fundamentally different from anything that has existed before. Cash doesn't have conditions. A $20 bill doesn't know where you are, who you are, or what you're buying. A CBDC knows all three, and it can act on that information in real time. This is the architecture the hook was pointing at. Every move, the EU cap, the CBDC rollout, the programmable payment pilots, only makes coherent sense when you read them together. Taken individually, each one has a defensible public rationale. Taken together, they describe a system where every financial transaction you make is visible, logged, and ultimately subject to conditions set by whoever controls the ledger. If this is genuinely about modernizing payments and stopping criminals, why does every single proposal also happen to eliminate the one payment method that leaves no record? Criminals have been laundering money through shell companies, crypto mixers, and offshore accounts for decades. Methods that are entirely digital. Cash isn't their primary tool anymore. So, the crime argument is a frame. It's the packaging. What's inside the package is something else entirely, and the next piece of this is where it gets genuinely uncomfortable. Because once the surveillance architecture is in place, the question isn't just who can see your money, it's who can reach in and touch it. The EU's $1,000 cash limit in France, does that feel like fighting crime to you, or does it feel like something else? Drop your answer in the comments below. Because the next part is where this stops being about Europe and starts being about your wallet. Now that the surveillance architecture has been established, the EU caps, the CBDC rollout, the programmable payment pilots. Let's talk about what they actually do with it once it's in place. Because watching you is step one. Step two is where it gets surgical. Here's the mechanism that central banks have wanted for decades but could never fully deploy. Negative interest rates. The idea is simple and honestly, kind of audacious. If the economy is stalling and people are hoarding money instead of spending it, you charge them to save. You make the interest rate negative, so your money sitting in a bank account is actively shrinking. The ECB experimented with this. Sweden's central bank was the first to try it back in 2009, and the European Central Bank followed in 2014, dropping its rate to negative 0.1%. The theory is that if saving costs you money, you'll spend it instead, and that spending stimulates the economy. The problem? Cash. Physical cash breaks the whole model. If your bank account is charging you to hold money, you just withdraw it. You stuff it in a mattress, you opt out entirely. The penalty rate becomes unenforceable the moment people can walk to an ATM. Central bank economists have known this for years. Cash is the escape hatch that makes deeply negative rates functionally impossible to sustain. Now, eliminate cash. Suddenly there's no exit. Every dollar, euro, and pound lives in a digital account. The negative rate applies universally, automatically, with no opt-out available. The escape hatch closes. Your money starts draining on a schedule set by people you didn't elect, in response to economic conditions you didn't create. And there is nothing you can do about it because the alternative, holding physical currency outside the system, no longer exists. That's mechanism 1. Mechanism 2 is less abstract and, if anything, more alarming. In November 2016, India's Prime Minister Modi announced that 500 and 1,000 rupee notes, 86% of the money supply, would be removed from circulation overnight. The stated justification was a surgical strike against black money in the economy, crime, tax evasion, the same 3 words. In a largely informal economy where the most vulnerable people still had no access to digital payments, demonetization was a draconian measure that did a lot of damage. A study of hundreds of households from villages in southern India found that more than 1/3 had less work after demonetization. Agricultural wage workers and the self-employed suffered the greatest effects. The people who got hurt the worst weren't the tax cheats. They were the people who had no digital alternative, the ones the system had never bothered to include in the first place. That's the preview, not a distant hypothetical. That already happened in the world's largest democracy within the last decade. And what India demonstrated is that when you remove cash, you don't just inconvenience criminals. You remove the financial floor from everyone who lives outside the formal banking system. And you do it instantly, with no warning, no transition period, no appeal process. One announcement, one night, gone. Now scale that to a CBDC world. You don't even need to remove the currency. You just freeze the account. One database entry, and someone is economically invisible. No court order required, no due process timeline. The money still technically exists, it just doesn't work anymore. And the category of people this could happen to isn't limited to criminals or dissidents. It's anyone a government decides is inconvenient. Anyone who protests the wrong thing, donates to the wrong cause, or buys from the wrong vendor. This is the part the convenience framing is specifically designed to obscure. Every structural benefit of a cashless system flows upward, to the institution, to the central bank, to the state. The surveillance is theirs. The negative rate enforcement is theirs. The ability to freeze, restrict, or program your money is theirs. You get tap to pay and slightly faster checkout lines. Cash isn't a relic. It is the only financial instrument in existence that cannot be programmed, frozen, or made to expire. It is a check on power, a physical, portable, anonymous check on power. And the people dismantling it understand exactly what they're taking away. The question was never whether a cashless world is coming. The question is whether you understand what you're giving up before the door closes behind you. Subscribe if you want to keep seeing what they don't want you to notice.